Hello people, welcome back. This is the Complete Trader and you're welcome back to the channel. And so in this video we will be starting off talking about the Forex master pattern, and this is the type 1. Okay, so like I promised in the former video, we are going to be revisiting the Forex master pattern. If you remember, I posted one time about the Forex master pattern, and the reason why I'm bringing it back is because lots of things were not talked about there. And I believe that as a trader, okay, so the end of every information you get is to enable you take it to the market, something that you should be able to take to the market and practice in real time. Okay, and going round as well, I discovered that there's a lot of deficiency in the knowledge that is given out about the master pattern. So people are not shown the logical point where they can come into the market. Not much explanations are done concerning the master pattern, and so that's why I'm bringing back the first master pattern video. And again, I discovered that there are actually two types of first master patterns. That's because of the operation of the big players, and the second type is not being taught at all. I've not seen it anywhere that it has been taught, and this may be the first place you'll be watching it, but I just want you to understand that there are two types. Okay, and so let's go deep right into this, okay, because of time. So this is the first master pattern, type 1, and the first master pattern plays out as a result of what the big traders do in the marketplace. Okay, so what the big players do. Under the big players, we find the big traders. These are people who trade in large quantity. Okay, and then you also find the liquidity providers. So those are the two groups of people or groups of entities under the big players. All right, so now the big players or the liquidity providers, they operate in similar fashion. Okay, I think I've mentioned this somewhere else, I think in the video on B2SSTP pattern. So but they operate in similar fashion. Okay, so for the big players, for instance, if they want to buy, because they trade in large volume anyways, so they look for liquidity, okay, to enable them buy. Okay, so they need to look for sell side liquidity to enable them buy, and if they want to sell, they will need the they will need buy side liquidity to enable them to sell. Okay, and then for the liquidity providers, for them to make money, they need people to lose money. Okay, that's just the plain way of saying it. I'm just going to say it as it is. Okay, so when you come to a market where you have liquidity providers, as the brokers, so liquidity provider being the broker, being the one that delivers the product, that owns the product. So talking about things like synthetic indices, these guys deliver price to you. Okay, and so for them to make money, guys, you have to lose money, because if you are making money, they are losing money, and if they are making money, you are losing money. Okay, so that's just simple. And so when you get down to the root of or to the way this whole thing plays out on the chart, their operation, the two of them, the operation is similar. Okay, so there are 3 steps that these guys take. That is why you have this pattern playing out always. And the type 2 first master pattern as well is no different. So when we visit that one, you will see that it is still the same thing, okay, playing out, but it has different shape, and that is why I just named it. I gave it two types of patterns. So here we go. The type 1, the step 1 rather. The step 1 is that the create or the seek liquidity. Okay, so they create or seek liquidity. Now the purpose for doing this is very simple. Like I told you guys, the operation of the big players are the same. So if you're looking at the big traders, I mean people who trade in large quantity, you know that obviously, I'm sorry for that. So obviously if they want to buy, for instance, they need to create liquidity. What kind of liquidity? Sell side liquidity for them to be able to buy. And I told you guys in the B2SSW pattern videos that under lows, under reference points, under reference lows like daily lows, monthly lows, weekly lows, that's where you're going to find your sell side liquidity, or double bottoms, okay, triple bottoms. That's where you find your sell side liquidity. So if you have a clean double bottom like this, okay, so resting below there is going to be sell side liquidity. Now that's because of traders who are trading long here, trading the pattern where you have a double bottom, or trading a reference point, okay, and so they're going to be buying that, expecting price to find support at that area. And so if they're buying, they're going to be placing their stop loss below, and that is in the form of sell side liquidity. Okay, so that's a form of sell side liquidity. Now there are also other group of traders who believe that if price breaks down here, that's going to be that the market is going to drop down. Okay, so they believe this to be a very key level, and that if price should break down, it's going to go, you know, just down. Those are people who believe in buy pressure and sell pressure stuff. They believe that if market should break through here, then the sellers are definitely in control of the market and price should go down, you know. And so those people are going to be trading breakouts. And so that is also another group of people bringing sell side liquidity into the market. And so the optimum point for the big players, or the big traders rather, to buy is below this point here, because right below there you have lots of sell side liquidity flooding to the market. Okay, and so price goes here, and then you will see something like that happen. So right in that area they will be buying. Okay, they'll be buying. Okay, and so same goes for the liquidity providers. So liquidity providers, like I told you guys, their job is to turn and overturn liquidity. And so when it comes to synthetic indices, mainly these guys, they actually make money from, you know, traders. All right, now the operation in the forex market, for instance, where we have the currencies and stocks, could be different. They can assume the position of market makers for big players. Okay, so they can help them to look for liquidity, make the market look for liquidity, you know, and enable them to fill up their orders. But in a market like synthetic indices, the operation is still the same. Okay, but just with a little bit of you know, difference, but at the end of the day still the same. The job is to overturn liquidity, they turn and overturn liquidity, and the only way they can make money is if you as a trader, okay, will lose money. Yeah, that's just it. So if you are buying at any given time that you're buying, they are providing you the other side liquidity, or the counter side liquidity. So when you're buying, they are selling. And so if you buy and price goes higher, okay, it means that you will be selling at a higher price to them. So they bought low, and they sold to you low, and they'll be buying back at a high price, which means they've lost money and you've made money. Okay, so they will do everything in their power to make sure you are trading in the wrong direction. Okay, and so when price goes below here, because lots of traders have been taught about support and resistance and all those stuff, you know, this is why you're going to have lots of manipulation at reference lows, you know, which would be daily lows, high, and, you know, reference lows or reference highs, you know, in other words, reference points. So that includes daily highs, daily lows, weekly highs, weekly lows, and other stuff. Okay, or you can have double bottoms and other stuffs. So people have been taught that these areas are strong support, strong resistance, and all those things. And if you read books out there, about 99% of books, anything that teaches on technical analysis, that's just it, guys. Support and resistance, trend lines, and all those things. Okay, and so below here will be people selling, right? And so if they are selling, if people are selling down here, what do you think the liquidity provider will want to do? They will want to take price up once price gets into this point. So this is why I said the operation is similar to the operation of the big players. So if we can capture what the liquidity providers are doing, so we can also capture in that same attempt captured what the big players big traders are doing. So that's it, guys. Now when they create liquidity, okay, the next thing they do obviously is to take the liquidity. But let's look into this point of liquidity. So here you have the point where they are creating liquidity. So price is coming down. So in this market, they want to buy. Okay. But as price is coming down, watch what happens. They create some false support. Okay. So ignore this star and this level for now. So, but they create support, false support. And what happens is that people begin to buy at support, and some are waiting for a breakout, that if it breaks out, they trade to sell and stuff like that. So below that support level is going to be what? Sell side liquidity, right? And so they want to go long. Okay, so they want to go long. So where's the ideal point for them to go long? After creating the liquidity. Now, I must tell you guys that this level where they create liquidity can actually play out in different fashions. Okay, that can play out in different ways. So you can have them create liquidity in different ways, and you can have them seek liquidity. So for example, creating liquidity could be something like a squeeze coming down. Okay, especially after a very sharp run like this. So people begin to trade the trend line as it drops. Okay, and then they will just take it like this. People begin to chase that, and then they take off. Okay, or you can have some chart patterns coming here. So as price is coming down, you can have something like a bear flag, or is it called bearish flag or something? And so people will be trading the breakout, and so they take price back up, and those are examples of them creating liquidity, okay, with price patterns and stuff. And if they want to seek liquidity, then this could just be them taking price, close to a daily low, or and stuff like that. So daily low, a reference point, or weekly low or monthly low, and that is the point where naturally there's going to be resting liquidity. Okay, that is them seeking liquidity that is already in the marketplace. So that's why I have it here as create or seek liquidity. Okay, so this, you have to keep it in mind, can play out in different fashion. Okay, and so after creating liquidity, the next thing for them is to do what? They take liquidity, and that is when you see the manipulation of price deep into the level where they have that liquidity that they need. So below that point is where you have them taking the liquidity, and then after taking liquidity, the step 3 just naturally occurs, which is price will expand in the direction that is beneficial to the big players. Okay, so if you have it as the liquidity providers or the big traders, after taking the sell side liquidity, it just makes sense for them to take the price to the upside. Okay, and that's what you have, guys. So that process repeats itself over and over and over and over again. This is actually your master pattern. Okay, that's what you have as your forex master pattern, guys. All right, so that's really a simple way of saying it, I know. But truly it is all there is. Okay, it's all there is. This you see right here is just all there is. It plays out over and over and over and over again. Okay, and if this is not playing out, then you have to check out the other one. Okay, so but now there are a couple of things actually that makes me trade this with high probability and with a good risk to reward ratio when trading it, and one of those things are key level. Okay, so you see this star level I said you should ignore for a while. This is a key level. Okay, so a key level mainly is a level you spotted on a higher time frame. Okay, so a level you spotted on a higher time frame where you expect price to reverse from. Okay, so where you expect price to reverse from. So you can have this on a higher time frame as a key level, and you just go down to a lower time frame to expect this kind of pattern to play out. when you have this pattern rooted, okay, in your key level on the higher time frame, then you have a very high probability of winning your trade. Okay, so that's just number one factor that can help you. And the number two thing is that you want to monitor structure. Okay, so this is your structure. So market is coming down. You want to see them actually playing out this. Okay, so this is structure. So structure also includes your break of market structure. So right here you see that the broke market structure. Can you see that? So that is an invitation to you that market is reversing. Okay, so here you have a break of market structure. So you want to pay attention to that on your lower time frame. So that's another factor that helps me to get a very good risk to reward ratio, high probability entries and stuff like that. So number one is what? Key level. And you understand that for key levels, you want to be trading either in the trend of the high time frame or at a very, very high probability level. So this could either be a liquidity pool or any level on on the hard time frame. If you can have this pattern playing out on the hard time frame, and this level here could either be any of these levels that you could be looking to enter, okay, for the next leg of this pattern playing out on the hard time frame. Okay, I hope the point is clear enough, guys. Okay, so the next thing that enables me to interact with this pattern or engage this pattern in the market with high probability is imbalance. Now those are things that are beyond capture. I cannot capture that in this drawing really. Okay, and so those are the things that we talk about mainly or deeply in the training course. Okay, but let me walk you through these levels you have right here. Okay, so number one, I said you have your key level. Okay, and your key level can be anything, like I said before. Okay, it could be anything, but your higher time frame key level, that's where you have the pattern rooted. So market comes down, okay, gives you the false support, liquidity created below there, and now they take the liquidity. Okay, so if you are sure about your key level, right, you could take your entry right here. So that's your first point of entry. Now that's really, really aggressive, and if you're starting off right with a concept, you don't really want to do that. Okay, so what you want to do is to wait for them to show you their hands. Okay, you want them to show you that they are actually buying or using the liquidity that's sitting below here to go long. Okay, so once you see that playing out in this move right here, then you can say, okay, now they are using the liquidity right there to go long, and so you can now expect the other legs of the pattern to play out. Okay, now that doesn't mean it's going to play out 100%, but you have a very high probability of this playing out, or at least giving you a point of entry. Okay, so what are these points of entry? So once price breaks market structure here, this is a break of structure, so you have this high broken by this movement in price, so that's your break of structure. Now what are the logical points that you want to enter? Okay, so you have this point here, one, and this one right here. So you draw them out. So that's what you have right here. So this point right here or this point right here. So price coming down here could react from this or could react from this. Now how do we know where it's going to react from with high probability as well? That is when we need the imbalance to guide us. Okay, so these are some of the things that we may not be talking about in this video, but anyways, you have price coming down here, it could react here, it could react here. So these 2 points gives you possible points of entries. Okay, it gives you possible points of entries. Now what you need to understand is that this point here is a point where they decided to take price below the area of liquidity. So most of the time this move is an engineered price move. So coming back here, they want to be mitigating the orders that they use to manipulate price to the lows. Okay, and so that's why you have that as a possible point where price will be reacting from. And then you have this point here as well. This is an order block. This is an area where they enter their orders, and so this for you, we can say it's a demand zone. Okay, so this was the point where they first entered their demand into the market, which caused price to move up to break this market structure you have here. Okay, and so price reacting or retracing back to that level as well could give you a very high probability entry with good risk to reward ratio. Okay, all right, so you want to understand that all of these is building on the fact that you have this key level right here as well. Okay, and then you have structure, this structure playing out on your time frame, on your lower time frame or time frame of entry or whatever. Okay, and so this can actually be taken down to different time frames, so you could do your multiple time frame analysis on it. Okay, and so as price drops there, you can expect the reaction from these two, and you'll be guided by your imbalance concept. And so let's say you have a react from here or here, so you can have price break structure and continue higher. And so once price breaks this high next, whether it reacts from here or here, once price breaks this level here, you now have, mainly two levels where you can expect price to retrace to again before you can now participate in the development of these market structure. Okay, so where are those levels? So if price came back here and moved, continued the price leg from here, the picture here, if it is good imbalance, before price left this point, if this price move away is very strong, you can expect price to come back in there to balance up the leg and fill up more orders. So this could be demand being transferred from here into this level, and you can expect that to be revisited before price moves up again. Okay, or if price should react from here, okay, instead of this point, that same thing is applicable. So you could have them coming with orders right here, because there are times when they are mitigating positions, they are losing positions here, which they entered into the market for the purpose of sending price into the liquidity pool, right? So when they come back here to mitigate that, it is possible that they've added more orders. Okay, now you can see that with the way price moves away, and so you can expect that when price come back there, okay, after this break of structure, once price come back there, you can expect market to continue higher. So that also is another possible point for you to enter. Now another point for you to enter again is this high right here. Okay, and that's especially if it is broken with strong movement of price. Okay, if it is broken with strong movement of price, it gives you a very high probability of price coming back there and just moving away from there. So lots of people have been taught about the master pattern, and what they hear is that right here there's accumulation of liquidity, which is true. Market comes in there, takes those liquidity and moves away. But the problem with a lot of people is that now if market is coming back down here, okay, they don't know the next logical point where they should come in. Okay, of course, the next logical point where you should come in is the point where the market is actually reaccumulating, and so you can expect to catch a second movement of price to the upside. Okay, but I just gave you that right here. Those are logical points, okay, where you can be expecting the reaccumulation phases to occur, and then you can expect to go long, okay, as the pattern develops, right? So there are four things actually that enables me to interact with this pattern with high probability, and let me point that here before we close the video. Okay, so number one is that we are considering the higher time frame key level. Okay, so we need this to be a key level, and so like I said before, a key level for me and my students could either be a higher time frame liquidity pool, or it could be any of these levels you have here. So let's say, for instance, you have this market structure, for instance, playing out on the daily time frame. Okay, so for instance, you have this on the daily time frame, right? So coming down to the 4-hour chart, you can trade once price gets into here. This could be your key level. Okay, you can consider that a key level while trading on the 1 hour. So a 1 hour chart, you can expect this pattern to play out right in here. Okay, so you can have something like that happen, a market dips into your key level, and then you can expect to trade that. Okay, I hope that's clear. Okay, so a key level for me can either be a liquidity pool or these levels on a higher time frame. So just if you have this market structure played out on the higher time frame, which is normally you're going to have it because these are the master patterns. Okay, and so that's the first thing I'm looking at. So the next thing I'm monitoring is structure on the lower time frame as price enters my key level. That's the next thing I'm monitoring. Okay, and what do I mean by structure? I want to see them, show me that they're taking liquidity. So they create liquidity, okay, and then they're taking liquidity. So this is just type 1. Okay, so when we look at type 2, you will find out that there's actually another way that they create liquidity. All right, so but anyways, we want to see that they are actually taking liquidity. Okay, and then you have a break of market structure, which shows us that you probably have the order flow changing. Okay, so when you have the break of structure here, that's when you have the order flow changing. So that's another thing I'm monitoring. I'm monitoring the flow of structure on the lower time frame. Okay, and seeing that break of structure give me confidence to now begin to consider the other factor, which is imbalance. Okay, so I'm going to be monitoring how price broke structure, how price is changing order flow. So the imbalance that comes with that will help me to check if this is something that is a sign of the big players entering into the market. So that's the number 2 or number 3 thing that I'm looking at. So I'm looking at the imbalance, the way price is moving, the flow of price as it breaks structure. Okay, so the fourth one is actually what I call a drawn price. So if price is moving up, where is it going to? Okay, so that's another thing that I'm looking at. So that could either be maybe a liquidity pool above price, or so liquidity pool, and so it could be both of them. In in some cases, it could be an imbalance. So strong movement of price in the upside, that price has to go back and rebalance. Okay, you just want to understand that these are the 3 steps only that these guys are operating, and this is the process that actually repeats over and over and over again, and that's what gives us the type 1 Forex master pattern, and this is also what gives us actually the type 2 Forex master pattern, as you will see in the other video. Okay, so I hope that adds a lot to you guys. So much love to you. Reach me in my Telegram if you feel like to drop some feedbacks or make some inquiries or whatever. Okay, and that will be dropped in the description area below. Okay, so that's for this video, guys. So cheers and God bless you all.